How's it going, everyone? Welcome to the Proving Ground Mastermind. We're going to get started here in about 3 minutes. How's it going, everyone? All right. As you guys log in, just let me know if you guys can see my screen and hear me talking, and we'll get started here in just a second. Awesome. Thank you, Stephen. Appreciate it. Awesome, Vincent. I did notice that. Welcome. Glad you're able to join us today. I mean, literally just this morning we saw your subscription come in, so glad that you're able to join us this morning. If you guys have any questions as you log in, feel free to ask, and of course along the way as well. I'll do my best to get to all the questions. All right, guys, let's go ahead and get started. Welcome to the Proving Ground Mastermind. We're going to go ahead and get started here. Along the way, if you guys have any questions, feel free to ask those. Matter of fact, right now, for just a quick second, I'm going to go to open it up and ask if anybody has any questions. Feel free to ask. Otherwise, we'll talk about a few things that I want to touch on today. Okay. All right. Looks like you guys are good to go. All right. So what we're going to talk about today is I want to mix together some things that we've talked about in the past and start bringing them together. I feel like in going back, we have very good retention in terms of masterminds. So people that have been with us even since the beginning are still with us today. And so I want to start connecting some of those dots in how to use indicators in combination with each other. I think it's something that is overcomplicated and can be much simpler than we sometimes realize. And a lot of times it's just a matter of trying to identify a good starting point. And so that's kind of the purpose of today's lesson. Now, I do want to clarify, just to preface, is that generally I work from a checklist, right? And if you guys are attending the Audit this week, I'll be doing the Audit. So I'll be doing on it Tuesday, Wednesday, and Thursday. So you guys can kind of see some of that, right? Where we'll work from a checklist and then analyze the indicators and place a trade. So essentially what we do is we go through our checklist, we set everything up, and then we take a trade. Today we're not going to be doing that. Matter of fact, we're not going to be looking at live market at all. But what we are going to be doing is kind of going over maybe some of our triggers or what we should look for when we're looking at indicators, but I want to start very simply first and look at just this kind of linear progression that you could potentially look at in learning how some of these indicators work in combination with each other and perhaps getting into something sooner than you would otherwise. So what we're going to do is an exercise that we've done in the past with pressure, but then we're going to add major, minor, and technicals. Now again, we're just kind of going over, regardless of what the market conditions are in these particular instances, we're not looking at announcements or anything like that. So obviously it's a very bad idea, but we'll still be able to make the point of how the indicators kind of work cohesively with each other. Okay, so first what we're going to do is we're going to look at some instances where the green pops on top of red or on bottom of red, so changes positions in pressure. So basically all I did is I went back to 2018, January 2018, and so you can see right here that this is 2018, and then I'm just going to wait for a change in position. So green is on bottom of red right now, and what we want to see is green pop on top of red. If it was on top, then we'd be waiting for it to pop on bottom, right? And so you can see where I've marked here is actually the first place it happened. So green pops on top of red. Now, in the past, all we did was went back and waited for green to pop on top of red and then point up in pressure. And then we marked it to see what we could have done in terms of trade, right? But in this particular instance, all we want is that short-term bias in our favor. So you can see down here in this pressure indicator, you can see I don't have major, minor, I don't have TNTs, I don't even have candlesticks. So all we're looking at is pressure, and then we're going to introduce major, minor, and then we're going to introduce our technical. So we can take this one step at a time. So right here, this would be, let's say, a lead-in to say, okay, whatever direction the market could very well have been going, perhaps it's going to start picking a different direction or softening to that direction or what have you. So right here, this would be cause to consider a long. Maybe not enter a long, but consider one. So here's our first consideration. Green pops on top of red. So then what we're going to do is we're going to open up our major, minor. And in our major and minor, we can see that we almost got kind of this hiccup pattern, right? Except we don't have a hiccup here. But the sentiment still applies, right? The same kind of concept applies. We can tell that the majors are not committed to the short, where the minors are much more committed. They're crossed and have already entered the channel. So this is showing us that we could very well be seeing a fake out and a potential long, right? And with green popping on top, that gives us another form of validation, right? Okay, so now we've got two forms of validation to go long. So the question then is destination. Where are we going long? So I have already drawn in some technical analysis here. You can see we've kind of got this uptrend. I've already drawn in some lines. We've got a pretty aggressive uptrend, as a matter of fact, and I've already got in some lines here. So to be unbiased, all I did is I went back to the beginning of 2018, January 2018. So if we were going to take a long here, we could justify there's about 12 pips to the long side. So we could justify about 6 of those pips, right? Because we're with the trend. So just remember this rule. With trend, so we'll just call it WT. With trend, we're going to take 50% of the distance between our current market price and our next level of support or resistance. So if we're going long and we're with the trend, then we'll take 50% of that distance. So if we've got 12 pips, then that's going to give us 6 pips that we could justify based on how we see the lines, right? The support and resistance and so on and so forth. So now we're looking for just a 6 pip trade. So let's go ahead and go forward and see what happens. Right there we got 7.4. So we get out of that trade. It drew down about 1.1 pips. That's enough to get out with spread, where the spread is perhaps 1.2 pips or so, right? All right, so we got our push up back to the top of the trend, and we only went part of the distance to resistance. You know what's funny is I didn't mark this one. This one popped on bottom as well, so let's look at that one right now. Now, this one, green pops on bottom, so we just noticed that. So I'm going to decrease these here for just a second. We're going to take this one step at a time. So here we popped on top. Here it's popped on bottom now. If I maximize that, you can see green's on bottom. Okay, so Now we're going to look at it the other way. Is there any cause for a short, right? So let's go to our major minor, and we can see that in any fake out or like a head fake scenario or hiccup scenario, the follow-up is usually both major and minor pointed up. So the hiccup pattern is a pattern based. These pointing up after the fake out, hiccup, head fake, or the like, gray dagger, anything like that, these both pointing up without majors leaving the overbought in this particular instance would actually be cause for a short. This is a predictive trade, right? Even though it may not make sense to you right now because perhaps you don't understand the indicators that in depth quite yet, we understand that we are vastly overbought now after having faked out the minors. Minors got stopped out, so there may not be very many buys left in the market here, right? And so as a result, we know that we're likely to short. Now, if we want to position, then we'd probably use a 5-minute chart to see where a good entry would be, 5 or 10 minute or something to see where a good entry would be on a short, right? So here we do have cause for short. Green popped on bottom, and we have both major and minor pointed up after the fake out. Not just because they're pointed up, but because they're pointed up after the fake out. So this would be more of a predictive type scenario than it would be a reactive, meaning reactive is when the indicators are pointed in the direction, that's the direction you trade as long as you have enough validation for that direction. Pattern-based is just some of the patterns that we've gone back and taught you guys about. And then predictive is actually not counting on the indicators pointing in one direction, just understanding how they work and how the market in general works in order to execute more proficiently. So here we'd be looking for a short. And if we take our technicals, then we would measure from there to there, which is about 10 pips. Now, the next rule is against trend. So with trend, WT with trend is going to be 50%, right? 50%. And against trend, let's just call it AT, against trend, would be half of that, 25%. So roughly, if it's less than 3 pips, you probably don't want to take it. We've got about 10 pips, we could, which would mean we could only justify about 2.5, so let's just round that up to 3 pips. So we can justify 3 pips to the short side, which is 90+% what we're going to get with this particular pattern anyway. That's not to say that that's all we'll get, but regardless of market conditions, that's generally what we'll pull from something like that is just a quick 3-pip scalp. So in order to get 3 pips out of the situation, we actually have to move 4.2 pips from here, from this point down, right? So almost a full retrace of this whole candle. If that makes you uncomfortable, just don't do it, right? Okay, so let's see what we get. Gap. So that was not fair, nonetheless. Went 3.7 gap, and then it went 3 pips. Did not give us our 4.2. Had we entered at the open of this candle, which is where we should have entered, then it would have given it to us. However, we probably wouldn't have taken it nonetheless because this looks like it's probably a Friday, right? And so we wouldn't have been able to take the trade right there anyways. We would have had to wait till Sunday. And generally Sunday, you're going to have an increase in your spread as well when the market first opens. So would you have taken the trade? Probably not. Had you taken the trade, would you have been successful? Probably, right? Because that's about 3 extra pips. So even if you had 3 pips of spread at that point, you still would have gotten out of that trade with a 3-pip. But let's just call that one a wash because it gapped, and that would have been a Friday, and we wouldn't have taken the trade anyways, right? All right, let's decrease these. And here, I didn't mark that one either. Here it actually pops on top. Green pops on top. So this is the open on Sunday. You guys know how I feel about Sunday opens. I don't usually trade until 4 hours after the open, so I can get a fresh 4-hour post. Any kind of gaps that have happened have normalized, so on and so forth. Nonetheless, we're going to take this and look at it. Green pops on top. So now we're going to open up our 60-minute. Do we have any cause at the post there to continue long? A little bit, right? Miners are indecisive. They haven't really decided to short, but they're not exactly agreeing with the majors quite yet. Majors are still pointed up. Now let's look at our technicals. And with our technicals, we have about, 5 pips or so. So let's just say, call it another 3 pips to the long side. We know that we're running out of space to the long side. Of course, we've already closed the gap, so we're not too concerned about that. But and we are in an uptrend, but we do want to be very cautious about our approach here, just because we are overbought and it is market open. But let's go ahead and look at it, right? Because we said early on we're not going to consider those things. We're just going to look at what's in front of us. Now, we are overbought, and a lot of you guys might be very reluctant to trade overbought, and that's fine. If that works for you, that's great. Or trade buy overbought or sell when it's oversold, and that's totally fine, right? Wait for your setup, wait for what's comfortable for you, and that's totally fine. But it is noteworthy, it is helpful to understand how the indicators react overbought. A lot of times if the majors still want to push long, then they'll try to get the miners to push short. So let's go ahead and look at this and see what, do we have cause to go to continue long? Well, yeah, because we had positive convergence, meaning green was leaning into red and popped on top, and now they're both pointed up. Now, again, this is Sunday market open. We do have majors pointed up, minors indecisive, overbought, so we could still see some fallback, but also continuation. So that's where the 5-minute or 10-minute for positioning would come in really handy to give us some insight as to whether or not we're going to see some of that pullback first, or if we should just go ahead and commit from this close on the 60-minute. Now, we know we have about 3 pips of space, given that we have about 5 pips to our resistance, so we'd only be looking for a scalp. So let's go forward. And we draw down about 1.6 pips, and then we went 7.4. And it went beyond resistance, but we're not counting on it going beyond resistance. We want to play within our boundaries. And so we played it safe, and we did just fine. If you guys find that you're missing by, micro pips and you're frustrated because of the spread, you're doing it wrong, right? If every once in a while it happens, that's fine. But if you find that you're missing really often because of spread or what have you, you're cutting it too close. So you got to rein it in a little bit. All right, so we got that trade, and that was just fine. Okay, so we've got up right here, but we're going to wait for change in position. In other words, we want green to pop below red. And until that happens, we're not going to do anything. So right there, next candle, green pops below red. So let's go. Now we have cause for a short. So let's go to our major minor, right? Do we have any cause in the major minor to go short? Very little, right? Very little, with the exception of the fact that they're overbought and they've been there for quite some time. Majors are indecisive, trying to get minors to commit to the short. And you can see that right there. And a lot of times what will happen is if minors don't commit to the short enough, then majors will actually cross a little bit, and then minors will really commit and get into the channel. And that kind of gives us our head fake scenario, which is where we would actually go long and then consider a short and then another short. But in this particular instance, we don't have a lot of cause for that, right? And if we're not comfortable with what we see in front of us and we're just basing it on pressure, green popping on bottom, we want to be a little cognizant of that. We want to be sure of that. And so this may be one that we skip because we're not using the 5-minute in this particular instance or any other disciplines. We may want to sit that one out. Let's look at our technicals and see if we can get any other form of validation to justify a sell. So we have about 3 pips to the long side before we touch resistance, and we've got about 7 pips to the short side, right? So if we're only taking 25% of the short, then we're looking at 2.3 pips. So we would be hard pressed to try to justify 3 pips where we'd have to get about 4.2 with such a little bit of space. So we may sit that one out. Not to say that it wouldn't go, right? But if we're not certain about it, then it's better just to sit it out and not do anything, or wait for a better confirmation to short. And sometimes it's by way of resistance or shorter term charts. And so if as we get to resistance and in a shorter term chart, we see that we could have some cause to scalp the short side, then by all means, that's what we do. Otherwise, what would be a better use of this particular setup would be to wait for a long position. Now, sometimes if we're getting some retracement, some significant retracement, waiting for a long may take a couple of hours, right? Because we want the majors and minors to kind of come down, you know, over outside of the overbought and settle somewhere in the low channel to oversold, and then try to take the long with the overall trend, right? But let's just say that in this particular instance, we did use this green on bottom for a justification to sell. We have miners kind of shorting, but they're not giving up enough. So let's just assume that majors are going to try to use a little more convincing to try to get them to short, right? So do we have anything concrete here that tells us to short? No, we're kind of reaching, right? But let's, so would we do anything with the information that's in front of us? Not likely. We probably wouldn't do anything quite yet, not with what's in front of us. There are ways to justify taking a short, but again, we're not looking at those right now. So let's just look at what's right in front of us, and let's just assume that we're going to skip it, but let's see what happens. So would we have been able to get something out of that? 4.8, yeah, we would have been able to get our 3 pips, right? So let's go back and look at that, because that's a little too close for comfort, right? That's a little too tight, 4.8, and we need 4.2 of those to take profit. So I mean, that could very well have not gone that extra, and we would have missed the trade, right? And ultimately, where did it go? It went to the long side. At that point, I'm sure that majors and minors look vastly different. A lot of times it's noteworthy to replay a chart, because majors don't necessarily have to wait for a post, where minors generally do wait for a post. They want to wait for a post on a shorter term chart or a longer term chart to justify their position, based on, you know, whatever archaic method they're using to get into the market. But a lot of times, if something happens in the market that is unclear, right? It doesn't look like, okay, why are the majors crossed and pointed down right now, where we already went down, we moved up more than we moved down, so why are they crossed and pointed down? Well, it pays to kind of see how they got to that point. And so if I take just this candle and I press the replay button and watch what happens to that chart. So let's not do all charts in chart book. Let's just do the single chart, this 60-minute, and play. Then I get to learn something new about this dichotomy between major and minor. So watch how, again, majors try to convince minors by even coming down a little bit, so that the minors will take the bait and try to short. And as that happens, the market did short, gave us the shadow right here. I'll put on indicators or candlesticks just so you can watch it form. So majors wanted minors to get into more of a short scenario, so that they can continue, the majors can continue long, because that's how the zero net market works. In order for majors to continue to buy, they need minors to sell. I'm going to speed this up so we don't have to watch this at regular speed. Let's go 50 times the speed. So majors are pulling up a little bit, minors are still heading down. Majors see that they're using the fact that minors are using that counterweight to the short side to pull the market up a little bit, right? They see it's not enough. They keep on hitting that ceiling. So now it's essentially what they're doing is just taking those profits, right? They're not necessarily selling here. They're just taking those profits, which is causing for these lines to bend down, which is giving minors more confidence in the short, right? And as they kind of push it down, the minors try to, you know, add more lots to the short side, then they can justify some more of that push long. But what they really want to do is they want to break that ceiling, right? But in order to do that, they really need to get minors to commit to the short. So right there, they move their 4.8, and then as minors are still selling, majors have the ability to buy, right? And then once they hit that ceiling up here, they end up having to digress and pull back down. And that's how we got this little down pull right here. You can see these candles look different than these because those are larger. I don't have any indicators on here, where here I have some indicators, but 4.8, 4.8, the pull down was about 2.6, 2.6. You can see the exact same. All right, So let me go back. Oops. Forward. Play at a high speed. So let's play. Okay. All right. So we skipped that one, right? And rightly so. All right, so let's wait for our next change in direction. So we didn't do anything there. Right there, green pops on top of red. With trend, and again, we have that positive convergence, meaning the green leaned into red and then popped on top. So they're really close and tight together. Right? Now, we've been overbought for some time, so we want to be very cautious, but this is a good buy signal, right? So now let's look at our 60 major minor. And at the very same time, we have both major and minor on with this really tight pressure. Major and minor are both pointed up. After having kind of digressed, and they're now both pointed up, which is usually cause for a short. So we want to be very cautious about continuing long there, right? If we did want to continue long there because of the strong pressure, we'd want to justify it with our shorter term charts, right? But a lot of times, even if it does continue long, we will get some pulled back there because we're vastly overbought, right? We're way high in the range. So let's look at our technicals. So our technicals have us at the top of the overall trend, right? We've now reached the top of the overall trend. So on top of the fact that we have major, minor both pointed up, and we're on top of the overall trend, we probably don't want to put too much weight on green popping on top on pressure, right? So we're more likely to see some sell before some continuation buy than we are the immediate buy, right? And that's not to say that it can't buy right now. It's just saying that we don't have a lot of weight in that direction. So when we look at the indicators, we say this is really good, right? This is like the ideal situation for a buy. Green just popped on top of red. It's really tight. That's very, very likely to give us some buy, some long, right? But this major minor being vastly overbought for quite some time now, and now both major and minor pointed up and posted that way, is also very likely to give us some short, right? And we're kind of right in the middle of a technical point. We could very well see some retracement back to support before we continue to resistance. So we could go down and then come back up, right? So where do we put our weight? What do we count on? Well, the answer is whatever you're most familiar with, right? Whatever you're comfortable with. If you've got a good exit method for something like this, or you can justify it with other disciplines like a shorter term chart or whatever it may be, then awesome. Then you decide if you want to buy or sell. So let's look at both. I would favor, personally, I would favor the short more than the long, but I couldn't even say that without looking at any other charts. So what would we do here? We do nothing, even though this looks very appealing, right? We know that we're still likely to get some long out of that. The question is how much and which direction is it going to go first? Because even if we're very likely to get long, it doesn't mean we absolutely have to. So there's about 11 pips there, right? And then there's about 10, 11 pips to the short side. Now, with the trend, the ideal direction would be long, but we're just so vastly overbought here, okay? So let's assume nothing, and let's click forward and see what happens. So we do get both, right? There's 9.3 and 10.7, right? And we actually moved more short than we did long, even though we would have justified taking more pips to the long side. We would have taken 5 pips to the long side, and only about 3 pips to the short side. Would both of those have been successful? Yeah, because that's a 3-to-1 trade right there. 3-to-1, you only have to be at like 80% win rate to hit a 3-to-1. So you took a 3 short, or you took a 5 long, and either direction, you had a 2-to-1 to the short side, meaning if you went long for 5, you only drew down twice that amount. If you went short for 3, you only drew down 3 times that amount. And you could have gotten 5 in probably either direction. However, you couldn't justify 5 to the short side because it was against trend. So we saw that we had some overbuy and we were cautious, so we did nothing in spite of the fact that we had the most ideal situation in pressure. But it's where do you put your weight, right? Yes, pressure in that particular instance looked absolutely great, wonderful. But in the same respect, we didn't have any other form of validation, so we can't just pick and choose. You know, when we get to a certain level of trading, we can't just pick and choose which ones we like to justify what we want to do, right? Which is very well to have bought, right? And with pressure like that, generally in higher volume times, we're probably not just going to take 3 pips, you know, or 5 pips to the long side. We're going to probably try to justify a lot more because that's strong pressure, and that's the situation we find ourselves, you know, all messed up in. And then we start second guessing our whole process and approach. But it's just a matter of where you put your weight and when you put your weight there. So the more disciplines that you're familiar with, then the more it kind of reins you in, right? But then you become a sharper trader, and you're content with having a day where you only make 10 pips. That's all I go for. That's all most of the time that's all I go for is 10 pips. And I'm content with that. So you got to figure out what works for you most of the time, right? And don't get into the habit of playing until you lose. Otherwise, you stay in the market and you don't know when to quit because you don't have any rules or any real structure. And so when the only time it's time to quit is when you lose. And hopefully you quit right then, right? You hedge or you stop out or trade, and then you just stop for the day. But generally, you know, sometimes some of you guys will get into this revenge trade mode, right? Where it's like, well, now I got to get that back. I got to win that back, or I got to figure out this hedge. I got to price average right now. If I take one trade a day, and that one trade I have to hedge, I hedge it and I walk away, and I'll be back later, maybe like 6 or 8 hours later. Generally, it's not till the next day. I don't even come back till the next day. And the next day, I do all my analysis again. I work through my checklist, and I determine if I can take a trade. All right, so let's continue here. If you guys have any questions along the way, of course, feel free to ask. All right, so green did pop on bottom right there. So let's, I think I marked that too late because I marked it over here. I'm going to move this, adjust this, because I'm not sure if there was another change in direction here, but if as I widen this, I can see green pop down bottom. You see that? So let's consider that. All right, so green pops on bottom right here. Pressure is really tight up, guys, really tight up. But I want you guys to see some of these nuances of the pressure indicator, how it can really benefit you and keep you out of trouble sometimes. All right, now let's go to our next, and we have the follow-up to kind of that predictive short, right? So here we had major minor pointed up, and that's why we were thinking the market was going to short, right? And now that it has shorted, we have a reactive scenario where both major and minor are double cross pointed down simultaneously, right? And in addition to that, green just popped on bottom. Now pressure is still really tight up, right? So we're using a really simple approach, but in your mind you'll say to yourself, after backtesting, you'll say to yourself, what am I most comfortable with? Am I most comfortable with just green being on bottom, or am I most comfortable with there being some divergence in green and red, some obvious divergence in green and red in pressure in combination with reactive, major minor? But let's just look at it for what it is. Do we have a sell signal here on pressure based on what we're looking at in pressure? The answer is yes. Green popped on bottom, right? Do we have any kind of sell indication on major and minor? And the answer is yes. They're overbought and they're both double crossed down simultaneously. So the answer is yes. Now let's find direct destination. Do we have enough pips from here to our next level of resistance, or support rather, to justify a trade? And the answer is no. We have 8 pips, and we can only take 25% of that distance. So that would be a whopping 2 pips. Not worth it. 3 pips or more is probably the least you want to take. 3 pips is the least, because there's no money in anything else. Let's just use Capital City Markets, for example. You have a 1.00 lot size. Obviously, you can incrementalize this. So if you're trading at a 0.1, then it's a tenth of this. But that's $6 per trade, win or lose. Here it's 60 cents, right? 60 cents. But let's look at $6 per trade. So if you took a 1.00 lot size for 2 pips, then that's $20 minus 6. You only make 14 bucks, right? So you lost about almost 30% of your trade to commission. If you just add one more pip, then this becomes 24, and that's down to 25% of your trade, right? So actually not 25%, sorry. It'd be 30, so it'd be more like 20%. It would be 20% that would go to commission, right, versus 10% less than that, over 10% less than that. So 3 pips is the minimum. If you have a smaller commission, cool, you might be able to justify 2 pips, but I mean, it's going to be frustrating when you take a loser. If you take 10 2-pip trades, that's a whopping 20 pips. You know, if you take one hedge position, you're probably going to be in a 20-pip hedge. And if you have to close that, then you're break even. So you took 10 trades, 11 trades, all just to break even, right? So you want to do more than just 3 pips. And you can't even do that much. If you're at an 80% win rate, you can't even justify a 3-pip trade, guys, right? And that's why we have the calculator. So let's look at the calculator. Let's say we have a $2,000 account. And let's say our win rate is 80%, which is an awesome win rate. You're only risking 1% of your account, and let's just say you have a 15-pip stopper, right? You'd have to take at least 5 pips because you have to use a 3-to-1. In order to justify 3 pips, you have to have a 9-pip stop. 9 pips. Unless you guys are using a 9-pip stop, which I can almost guarantee none of you guys that are on this webinar today use a stop that tight, then you shouldn't be taking a 3-pip trade if your win rate's 80%. And this is per currency pair. Excuse me. So that means that if you're at 80% on the Euro US and 76% on the GBP JPY, and you have more trades on the GJ than you do on the Euro US, but it's still bringing up your average to 80%, you're only trading 80% on Euro US, and then you're trading 76 on GJ. You're not taking the aggregate, the cumulative average. You're taking it per currency pair. So what is your win rate for the currency pair that you're trading on? And that's the one you use here, and that's how you justify how much take profit there should be based on what your exits are. And then your lot size is going to be according to your win rate and the amount that you have in your account. So that's, and what your stop loss is, right? Because a 0.22 for 9 pips is 1% of $2,000, right? So that's how it works out. You can't just decide you're going to take 3 pips. You need to be able to justify it with your win rate. Right? And I've showed you guys this a million times, but I'll show it to you again. If you took 3 pips on 10 trades, right, 1.00 lot size, that means that you already spent $60 on commissions, because $1.006 per trade times 10 is $60. You win 8 of those 3 times, or sorry, 8 of those 10 for 3 pips, that's 24 pips, right? 8 times 3, 8 trades, 3 pips, 24 pips. Okay, that means you've lost 2 of them. 2 of these trades you lost, right? So that means that if you had, let's just say 10 right here, look at this. Let's say you had 10 right here, right? You had a 10-pip stop loss with a 3-pip take profit, right? which is more than a 3 to 1. It's just above a 3 to 1. 10 times 2 is 20, right? So you think, well, I'm good because I made 4 pips. False. The difference is plus 4, yes, which at a 1.00 lot size is $40, right? But then you have a commission of $60. Minus 60 equals minus 20. So can you have a 10 pip? No. Can you have 9 pips? So this would be 18, right? Which would mean 9 times 2, right? Which would mean this is going to be 6, which would be $60 plus, because it's 1.00 lot size, so it'd be 6 pips, $60, and 60 equal each other out, so you'd break even. But at least you didn't lose anything. That's after commissions. Still a crummy situation, right? So you can't use that. You don't want to use that, right? You want to use more like a 2 to 1, right, with an 80% win rate. So that means that you're using more like 6 pips. That's a 2 to 1. If you're not using 9, you're definitely not using 6. That's 12. That would be 12 because plus 24 minus 12 is 12. So that's $120 minus 60. So that'd be a plus 60 after all was said and done, because 120 minus 60 is $60, and that's after commissions. So you'd make $60. So that's where you'd have to be. If you can't do that, if you can't call the market that tight, then you're not going to be able to take a 3-pip trade. It's just how it is. You may win every once in a while, but when you lose, those losers are going to eat your lunch. In that scenario, you won 8 times. You won 8 times with that same trade, but then you lost 2 times. And because your stop loss or your hedge position was too big, it wiped out all your profits. So can you even take a 3-pip trade with an 80% win rate? The answer is no. Therefore, if you're in this scenario, right, and you cannot take any, so 8.4 pips, right? 8 pips or so. So that means that if I'm at an 80% win rate and I'm trying to go for 8 pips, then the largest my stop loss or my hedge position would have to be is like 16, right? I can't go any larger than that because that's going to put me above what I need for my minimum take profit. So if I went 18, there you go, 18, and then I can take a minimum take profit of 6 pips. Minimum. I could take more if I can, but can I see 6 pips right here? 25% of the distance from current market price to support. There's 8 pips. I'd have to take more than 25%, right? I'd have to take like 80%. So can I justify that? The risk to reward is not there. Even if I've got good signals, even if it's the ideal situation and I haven't taken a trade for 2 days because I haven't seen the ideal situation, I don't do it because I have discipline, because I know in the long run I'm going to be successful as long as I do the right thing when the time comes, as long as I'm integrous to myself. Because right here, it is very likely that the trade would work out for 6 pips, right, or 3 pips, or whatever. But when nobody's watching, I still do the right thing, because ultimately, if I don't, then I make bad habits, and those bad habits end up costing me my account. And that doesn't matter if everyone is watching or nobody's watching. Losing my account, I'll lose it regardless of who's watching, right? So I make good decisions, I make smart trades, and nothing else. And if I find myself frustrated because I can't make trades when I want to, then what do? I back test and I get better at what I do so that I can make those trades in those scenarios and situations. Right? I'm not saying overanalyze, keep it simple, right? But don't water down the process either. Just get better at reading the indicators that you understand. You don't have to add all kinds of other crap. All right, so let's go forward and see what would happen. We would be trying to justify a short. Obviously, depending on what your win rate is, you could either take this or not. But in either case, the risk reward isn't there because we don't have at least 25% of the distance for at least a 3-pip trade. But if we did have at least 12 pips or so, then and our win rate was above 87%, then we could probably justify taking just that 3 pips, right? And we would have been successful. That one went 10.4. And this is the kind of stuff that you see and you're like, see, I should have just taken that trade. And you kick yourself in the butt and you start programming your brain to think that what you did was incorrect. And that's not true. What you did here was absolutely correct in staying out of that trade. Because remember, you'll win 8 of these, right? But the 2 that you lose are going to wipe out all the 8 that you won. So don't do it to yourself. Okay. So we did have enough justification, validation there, but we skipped it. All right, so let's go forward. We're waiting for that change in direction. Green's on bottom, so we want it to pop on top. I'm not implying that that's the only time you should take trades. I just want you guys to see some of these nuances, right? I mean, in just about any other situation, some of you guys may have put a lot of weight in the fact that green just popped on top here and they're sharply up, and they're still sharply up here. And most of you guys wouldn't have taken the time to see, did green pop on bottom? This is a lot of times how I'm able to get in and out of trades very quickly and effectively. It's the subtle nuances. I'm not saying complicate your process. If you have a process that works right now, continue to use it, but backtest this to try to get better in your process, right? I mean, you guys have a basic understanding of pressure, some of you a basic understanding of major minor, and then you guys are adding all this other garbage. Get very proficient, get expert level with pressure, get expert level with major minor, and then consider if you even need anything else. I'm not talking about support and resistance, technical stuff like that. You should always work on that stuff. You should always include that stuff, right? What I'm talking about is you haven't mastered even just the basic core 3 indicators, and you've got other stuff you're trying to add to your process so that your charts look like a mess. And you haven't mastered any of it. You just think that you need more forms of validation in order to justify a trade. Well, I got news for you. When all forms of validation line up, it's usually cause to go the opposite direction. Case in point. Here we go. Solid pressure going up. Green just popped on top. Tight, right? Major minor pointed up. Buy, big candle. There's your price action. We haven't touched resistance yet. There's a lot of cause right here to buy, right? When everything seems to line up, it's probably time to go the other direction. Don't bank on that, guys. I'm just saying, right? Don't overcomplicate it. You just have to, if you're not sure what to do, don't do anything. But backtesting will give you that insight. I can explain it to you till I'm blue in the face, and I try to all the time, but ultimately you have to see it for yourself. You have to experience it for yourself. And that's why I'll replay charts. Even now, even today, this weekend, I didn't trade, of course, right? Markets closed Saturday, but I took about an hour and a half, and I backtested and I replayed charts. Even now. And arguably, I'm one of the best at this. But I'll remain that way as long as I continue to stay sharp. All right. Decrease these. All right, so let's continue. So now we're looking for another change in direction. All right, there's green on top. So in this particular exercise, that's what I'm waiting for, is green on top. And let's go to our major minor. Do we have any cause to continue to go long? Where is our... Oh, that's not where we're looking at support and resistance. I'm like, where are my lines? Okay. Do we have cause to continue long? Well, yeah, majors are overbought, but minors are not, right? So we have them both pointed up still, a little more commitment than we've had in the past. We have green just popped on top, right? And we kind of busted this bubble right here, this kind of sideways bubble that we had for a moment as the market, consolidated. Now we've kind of got a little move up, right? Now, we are overbought on majors. Minors haven't quite made it there yet. We can see that we're definitely more comfortable with a long in this particular scenario than would be a short. So let's find destination. Let's see to where. So we did touch down on support back here a couple hours ago. Now we're looking at resistance of about 8 pips. So we could take about 4 of those, right? If we're playing really conservatively, we're just looking for 4, right? And if we did have an 80%, then it would be about a 2-to-1. So we're only looking for, there's a lot of support back down there. So, 8 pips, that would be tough, right? 8 pips, there's 9.6 right there. We could consider some type of exit outside of that. If that's the case, then we'd probably be looking for 4 or 5 of those pips. Nonetheless, let's just see if we can get that 4 just based on what we can see in front of us here. Okay. So 2.1 drawdown, and we got 6.8. Thanks, Steven. I appreciate it. So there's our 6.8, right? We didn't ask for much more. That's all we were looking for. By the way, all these are 60-minute charts. This is just pressure, major, minor, and this is our technicals. So we didn't try to, break the bank or go beyond, we just went for what we could see in front of us, and we took profit. Okay. So let's go to our next. Let's see where green pops on bottom. There it is. Green's on bottom. They're pointed up, but green's on bottom. Do we have any cause here for short? Little bit, right? Minors have kind of outrun the majors, but the majors are in the channel, so they have a little bit more commitment. Generally, when we see this, we look to pressure to see if we have any more validation. Right, so we are kind of doing a little backwards, but nonetheless, this is just what we're doing. Is the 60-minute chart the only one you use for this type of trading? Vincent, this is the 60-minute. How do I answer that? I don't necessarily trade this way. The way I trade is going to be, I use all my charts. On and right, hopefully you'll be able to trade better than I can. But the way I got to where I am today is based on that experience. And so what I'm trying to do is give you guys some insight as to some of the nuances that I look at so that you guys can get to where I am or greater without spending as much time as I have. So is this the linear progression that I use to place a trade? No, but the things that we're looking at are things that I take into consideration when I place a trade. And the reason why, and it's of no consequence whether I start with the pressure or major minor, because ultimately when I look at my charts, I look at them at a glance like this, from left to right, and then back again. And so I can look at them at a glance and determine what I want to do with just a quick glance, right? Now, I don't expect that you guys are able to do that, but someday I hope that you are, and at a higher proficiency than I can. So that being said, do I just use the 60? No, for this particular instance, I am using the 60 because it is one of the most commonly used time frames in the Forex market. So I want, and it's usually my anchor. So my 60 is where I'm going to make the decision as to what I'm going to do initially. Even if my 240 is saying long, for example, but if I get some short on my 60, then I'm going to be looking to short my 60 using my 5-minute to position a short on my 60, right? Because I know that that's what's going to happen first before even possibly the long, if I could justify enough movement in that direction using my 60 as my anchor. So you'll notice that a lot of times in these sessions we'll use a 60-minute as that anchor. And for some of these nuances, the 60 picks them up the best. So I realize that that's probably not the clearest answer that I can give you, but I'm trying to be very cautious as to how I present this stuff, because I want you guys to back test and see this through your own eyes and through your own experience. And I just want to give you guys some clues, right? I can try to teach you this all I want, but ultimately you're not going to figure it out until you back test it for yourself, because you have to see it through your eyes, right? It becomes very clear when I explain it, because I can explain exactly what I'm seeing in depth, in detail, right? But you may not see things the way I do. So if I'm not around when you're trying to explain it to yourself, it may not make as much sense because you're not looking at the major minor, for example, the same way I would, where what we're doing with pressure today is very simple. All I need is green to be on bottom, just have arrived on bottom, or just have arrived on top. But then when we get to this step, you may not see the same thing I see in major minor. But after I explain it, you'll see it very clearly, right? But that's only because I'm explaining it based on what I know of major minor. And so, of course, I can explain it very clearly. But you may not be able to pick up on that when you're backtesting. So when you backtest, you're going to see what you see in major minor and determine if that is what you need to see in order to justify using pressure in that particular instance. Or say to yourself, well, what I notice generally about major minor is different than what pressure may be indicating. Therefore, I, Vincent, am going to put more weight on what I see in major minor than I am on pressure. But I'm also going to consider what I'm seeing in pressure and be very cautious about this, right? So it doesn't matter if we use major minor first and then pressure, or vice versa. I'm going to put the weight based on what is in front of me as I put all the pieces of the puzzle together. Yes, that's right. Yep, small piece of much larger puzzle. If a lot of that sounded complicated to you guys, that's why it's recorded. So you can go back and rewind all that gibberish again and listen to it until it makes sense. So not trying to make it overcomplicated, just I do want you guys to really understand how we kind of put these pieces together and then where we put the weight depending on what we see in each of the indicators. Notice I'm not using TNTs. It's not because I'm dogging them. They're great, but generally you'll use pressure in TNT, not necessarily major minor TNT and pressure or major minor in TNT, because a lot of times they'll disagree. It's not because one's right and the other's wrong. It's just the nuance is different and they lead differently and at different times. Okay, so we can see some cause for sell right here on the pressure indicator, and we can see some cause for sell right here on major minor because they're both pointed down and they have a commitment to the short side because they both entered the channel. Now let's look at destination and pull this up here, and we can see that we touched resistance 1, 2, now 3 times, and we've got support that's below us about 30 pips or so. We could probably add, because this is a 60-minute chart, we could probably add another level just to be conservative. Let's just add a level right here. If we haven't made our trade yet and we're still analyzing, then you probably want to consider tightening that up just a little bit. Not that it's too wide for a 30-minute, but we know that, I mean, I'm kind of using the fact that I know this is around Sunday because we noticed that there was a market open along the way here. So it's about 15 pips against the trend. So, 4 pips maybe. 4 pips to the short side based on our indication here. And we do have a resistance level right above us, so we know that we could do something about our trade if the market were to go above this level, start breaking these highs and stay above that line right there. We could do something rather quickly because we have a resistance level really close to us. So this would be a really safe trade, right? Obviously, it'd be safer if we use a shorter term to position it, but let's just go ahead and look for 4 pips to the short side based on pressure, major minor, and the fact that we just hit a resistance level and we have plenty of space to the short side to take our 4 pips. And we went it's about a 1-to-1, right? We went 4.2 upside down and then 14.7 short, so we got our trade there as well. All right, so I'm going to wrap up with that, guys, because we got about 4 minutes left. Try doing that. Try going back somewhere random. If you guys had a hard time trading last week, for example, then go to last week and replay the same scenario to see where you probably could have gotten a better result, or why perhaps you should or shouldn't have done certain things, right? Look at your positive trades, right? Pat yourself in the back. Look at your positive trades and say, why did that work out? What did I do here that I didn't do it in this other situation? And maybe you did the exact same thing and it didn't work out. Then it's okay. That just means that it didn't work out. It's not always going to work out, and that's okay. It doesn't mean you change your whole process, right? If you find yourself consistently losing over long periods of time, then you probably want to fix your process. And that's where journaling helps, because did you add a certain, something to your to the equation, or what have you? There could be a number of things. But in all fairness, having gone back to every single one of these trades, did we miss any of them? No, we played very conservatively, and even the ones that we decided to skip, we probably would have made. And I've got other ones in here, guys. I mean, I literally went through, and every time that line popped on top or bottom, we made an accession of the market, right? Green pops on top right there. So do we have any cause for a long right here? Major, minor are in the channel pointed down. Now that's a lot of nuance, so we're not going to comment on that. But let's just say that, yeah, this is sell. This is actually giving us green on top with a buy, but it's pointed down, and then we just hit a support level. So you could justify a sell right here, which would be ill-advised, but you could justify a sell right here because major, minor, or pressure is pointed down, right? And this is where sometimes we get lazy because we just want to put a trade in. Well, major, minor pointed down right here, and pressure is down, and so we should just sell. Well, we haven't broke outside of support yet, but let's just go to sell anyways, right? Against the trend, and in spite of the nuance here, and whatever the case may be, and yeah, maybe sometimes you will sell. Maybe sometimes the market will sell and give you what you want, but where would you really sell to, right? I mean, here it's 14 pips, so what do you? Let's just say 14, so that's going to be 3 to 4 pips. Let's just say 3 to be safe, right? And you could probably maybe get 3, but let's see what happens. Yeah, you would have been fine. It only drew down 3.2, and you would have got 3. And then that bad habit right there would have compounded you continuing to do stuff like that, right? Was there cause to short? Probably not. Probably not yet. Not at that point. Maybe now more than before, because you're putting more weight, again, in major, minor than you would be in pressure, because green did pop on top. However, we are pointed down. So you're only taking about 50% of that, where in that case you probably have to just disregard pressure altogether and look at just major, minor, or whatever other disciplines you're using to justify your direction position. All right, guys, I'm going to wrap up with that. If you guys have any questions about this session or in general, feel free to reach out. Otherwise, we'll see you guys tomorrow. Remember that tomorrow is 7 p.m. for the Proving Ground review, 7 p.m. Mountain Standard, so we're no longer doing the 6 p.m. to 7 p.m. The Proving Ground review is now taken over the advanced course, and so for those of you guys that obviously are not in town, so cannot attend the advanced session, we are now doing, the Proving Ground review is now doing the advanced session every week from 7 to 8, so it will be broadcast via webinar, and you can go to this site. But if you want to chat, you'll want to use the link to the Proving Ground review so that you can chat in, because I'll monitor that chat at those times, because there are people that are both mastermind and non-mastermind members that attend that session via webinar and live and in person. Look forward to talking with you guys tomorrow. Have a good one. Thanks.